Hello everyone. So now we are going to move on to the next chapter in this particular video. That is, previous video we completed the ratio analysis. So with that we have completed two chapters, that is working capital management and ratio analysis. And now we will move on to this chapter number 10, that is leverage analysis. Take your material, go to page number 184. Go to your GC Rao Academy material to page number 184. That is leverage analysis. So this chapter number 10 is very easy chapter. That is, there are only few concepts, that is 3 to 4 concepts which you should understand in order to solve all the leverage analysis problems. So we'll start off with a little clarity over this topic. That is, we should have some understanding over this theory so that we can do the problems very easily. We don't have to go through all the theories. I'll just explain you what is there in what is the three concepts which you should remember. That is, what is the three concepts which are which is the main sole element of this leverage analysis. Which those three concepts, if you can understand, done. Leverage analysis is done. Okay. With that, we will move on to this chapter number 10. So basically, what is this leverage? Leverage is nothing but a variable having a relationship with another variable, so that a change in a particular variable will affect the change in other variable. That is, see, suppose sales amounts to 10 lakhs. So if sales is 10 lakhs, your profit is 5 lakhs. Suppose your sales is 15 lakhs, then your profit will change accordingly. So that is the relationship between two variables, that is a change, percentage of change in two variables, a relationship between that is called leverage. So the explanation they have given is leverage means influence of one force over the another. That is, because of change in sales, how much is change in EBIT? That is called EBIT is nothing but profits, earnings before income, interest and tax. Earnings before interest and tax, that is EBIT. So percentage, suppose a sales, there is a increase or decrease in sales. So whether increase or decrease in sales, how much increase in sales will affect how much increase in EBIT. That is, suppose sales increases by 50%, then how much of EBIT will be changed. That differences, that ratio is called as leverage. So there are three types of leverage, that is operating leverage, financial leverage, combined leverage. These are three important topics which you should remember in this leverage analysis. First is operating leverage. You just remember what is operating. Operating is nothing but the business, whatever is our business. Suppose my business is teaching, means my operating activity is teaching. Suppose I run an academy, then my operating activity is teaching. Suppose I run a financial service company, my operating activity is collection of money from customers, that is collection of fund from customers and investment in stocks. So that is the financial service company's operating activity. So whatever is your operating activity based on the business, based on your own business, that leverage of that operating activity is known as operating leverage. How will you calculate this operating leverage? Simple. See, operating leverage is nothing but your sole business activity. So that is sales of your business. So the operating leverage of your business can be calculated by finding the percentage of change in EBIT divided by percentage of change in sales. Simple. Suppose there are 2 years or there are two activities, that is at 1 lakh sales units, at 2 lakh sales units. Okay, at 1 lakh sales units your EBIT will be 20,000, and 2 lakh sales units your EBIT will be 30,000. So percentage of sales, percentage of change in EBIT divided by percentage of sales is called the degree of operating leverage, that is DOL. Simple. Operating leverage means it takes into consideration sales, EBIT, whereas the next is financial leverage. So first we'll get clear with operating leverage. Operating leverage is nothing but how much is your operation, that is percentage of sales affects the percentage of EBIT, that is called operating leverage. Your operating work is you are doing your particular product, you are producing a particular product and you are selling it. Okay, that selling of that product, that is sales, is your operating activity. So sales, from that you will detect variable cost, from then you will get contribution. So from sales, if you detect the variable cost, what is variable cost? Variable cost is nothing but cost incurred for producing every product. That is, it changes with increase or decrease in the number of quantity. That is, if suppose you are producing 10,000 units, variable cost will be suppose for producing 10,000 units, variable cost is 10 lakhs. Then for producing 12,000 units, your variable cost will be 12 lakhs. The percentage of change in variable cost will be as same as percentage of change in sales. Suppose sales increase from 10 lakh units to 15 lakh units. Then what is the percentage of increase? From 10 to 50% has been increased. Then variable cost will also increase by 50%. So there is no difference between variable cost and sales. So therefore, the percentage of change in sales and the percentage of change in contribution will be same, because percentage of change in sales will never affect the percentage of change in variable cost, because both will be moving in the same direction. So when sales minus variable cost, you will get contribution. That particular contribution will also increase or decrease in the same percentage as sales is moving, because variable cost is also moving in the same level. So there won't be much difference between percentage of change in sales and percentage of change in contribution. But after contribution, what you will detect? You will detect fixed cost. Okay, after contribution, this is marginal costing. You would have already studied in marginal costing. Sales minus variable cost, you will get contribution. From that, you will just reduce fixed cost. One thing you know about fixed cost is fixed cost will never change irrespective of change in production. Irrespective of change in sales or irrespective of change in production, there won't be any changes in fixed cost. So contribution minus fixed cost, you will get EBIT. So whether your sales increase by 10% or whether your sales decrease by 10%, your contribution will also increase or decrease by same 10% or 10%. But your fixed cost will be fixed at total. Like fixed cost will be fixed as total, and fixed cost will vary as per unit. That is the concept of fixed cost. You would have studied this in this marginal costing, that variable cost will be same per unit, but variable cost will vary as total. But fixed cost will vary will be same as total, but fixed cost will vary as per unit. If you calculate fixed cost per unit at different stages, that is different quantity of production, it will vary. Whereas if you calculate total fixed cost, it will be the same at different quantities of production. So this is the concept of fixed cost. So we don't want that, but we know one thing, that fixed cost will be always fixed. So contribution less fixed cost, you will get EBIT. So irrespective of changes in sales, there will be no change in fixed cost. So contribution will change. If there is a change in sales, your contribution will change, but fixed cost will be fixed. Because fixed cost is fixed, your EBIT will change. Can you understand? Suppose your sales is 1 lakh and at the other level 2 lakh. If you reduce variable cost of 50%, it will be 50,000 and 1 lakh contribution. Contribution is 50,000 for case 1 and 1 lakh for case 2. Your fixed cost for both will be 20,000. So your EBIT is changing because of the percentage of change in EBIT will not be same in both the cases, because fixed cost is same. Fixed cost is not varying as per the percentage of sales. Once you do the sum, you will clearly understand it. So whatever you are dealing with between sales to EBIT, that is called operating leverage, man. Simple. Whatever you are having the values between sales value to the EBIT, then that is operating leverage. And next is financial leverage. Whatever you are having from EBIT to the EBT, that is financial leverage. That's all. What is financial leverage? First, understand what is financial leverage. Financial leverage is nothing but how much your funds has been segregated into equity and debt. That is called financial leverage. Okay, suppose your debt equity ratio is 30:70, then there is a financial leverage in your company. If suppose your entire company funds are from equity, then there is no financial leverage. Your financial leverage will be zero. Only if there is a debt component in your company, then this financial leverage will come into picture. So how will you calculate this financial leverage? Simple. EBIT divided by EBT, or percentage of change in EBT percentage of changes in EPS divided by percentage of change in EBIT. See, simple. For operating leverage, sales divided by EBIT divided by sales. Okay, percentage of change in EBIT divided by percentage of change in sales. Whereas for this financial leverage, what is the last? After finding contribution, what you will do? Less fixed cost. Then you will get EBIT. Okay, from EBIT you will deduct interest. You will get EBT. From EBT you will deduct tax. You will get EPS. So this financial leverage will be calculated from the below. Same. First set is sales to EBIT is operating leverage, and from EBIT to EPS, that is next set of problem is to financial leverage. That is percentage of change in EPS divided by percentage of change in EBIT. As simple as that. For operating leverage, percentage of change in EBIT divided by percentage of change in sales. Whereas for financial leverage, percentage of change in EPS divided by percentage of change in EBIT. That's all. And one more formula is EBIT divided by EBT. That is, we have done this in interest coverage ratio itself. Interest coverage ratio and financial leverage and all, there is no much difference. EBIT divided by EBT. And for degree of operating leverage, it is contribution divided by it. See, simple. In the second problem, you just take it as example. For calculating degree of operating leverage, you should check the percentage of change in EBIT divided by percentage of change in sales. Or there is one more formula, that is contribution divided by EBIT. Simply, you just go from the top to bottom. That is contribution divided by EBIT will give degree of operating leverage, and EBIT divided by EBT, you will get degree of financial leverage. That's all. That's all. So EBIT divided by EBT is the financial leverage. And next, last one is combined leverage. Combined leverage is nothing but summation of both. That's all. Percentage of change in EPS percentage of change in EPS divided by percentage of change in sales. That's all. You just remember this. Degree of combined leverage is equal to degree of operating leverage into degree of financial leverage. Okay. Degree of operating leverage into degree of financial leverage. For degree of operating leverage, what is the formula? Contribution divided by EBIT into EBIT divided by EBT. So EBIT will get cancelled. So what you will get? Contribution divided by EBT. That's all. That is the contribution divided by EBT is the degree of combined leverage. And for percentage calculation, percentage of change, bottom line is percentage of change in EPS and the top line is percentage of change in sales. So that is the degree of combined leverage. Multiplication of degree of operating leverage and the degree of financial leverage is the degree of combined leverage. So with this, we have completed the theory part. It's very simple. If you do the sums, you will definitely understand what are the different concepts. So now with that, we'll move on to practicals. Chapter number 10. Take the notes. Chapter number 10, leverage analysis. There will be minimum of 6 marks in this particular chapter. As per the weightage, I have gone through, but sometimes they may not ask in exam also. So leverage analysis, but this is important chapter because it is very easy chapter to score marks. If you can solve this problem I think so, you will take only 5 minutes to solve this problem. So it will be time consumption also. So okay. Chapter number 10, leverage analysis. Okay, come to problem number 2. Take the book material, that is problem number 2, page number 186. A firm has sales of 10 lakhs, variable cost 7 lakhs and fixed cost 2 lakhs and debt of 5 lakhs at 10% rate of interest. They have given sales, then variable cost, then they have given fixed cost and also the debt of 5 lakhs at the rate of 10%. What are the operating, financing and combined leverages? They are asking us to find all the 3 leverages, that is operating leverage, financial leverage and combined leverage. And if the firm wants to double its earnings, that is if the firm wants to double its EBIT, suppose percentage of change in EBIT, what the firm wants is into 2, that is 100% of increase. That is, suppose yours is 100 rupees, rightly you are earning, it want to double. So percentage of change in EBIT is 100%. You want double means 100% should increase. So how much of rise in sales should be needed on percentage basis? They are asking how much of percentage of sales is required if EBIT should be doubled. So this is the problem number 2. So now come to the notes. They have given clearly what is sales variable cost. From that you will get contribution. From that if you deduct fixed cost you will get EBIT. And from that if you deduct the interest you will get EBT. So you will arrive at EBT. So you can find all three ratios, that is combined leverage, operating leverage and financial leverage. And from that the one more question which they have asked us, that is doubling the EBIT. You can use degree of operating leverage in order to find percentage of change in sales. So now take down problem number 2. Come to the notes. Problem number 2. Statement number 1. Marginal income statement of a firm. Below that, marginal income statement of a firm. Below the 2 column table. First column particulars and second column amount. Below that particulars, take down small a sales value. Amount column 10 lakhs. Small b variable cost. Amount column 7 lakhs within bracket. From sales, if you deduct variable cost, you will get contribution. So 7 lakhs within bracket. Now total it 10 lakh minus 7 lakh, amount column put 3 lakhs. Amount column put 3 lakhs. In respect of the 3 lakhs contribution. In respect of the 3 lakhs contribution. From that contribution, below that point number C. Point number C, less fixed cost. Always from the contribution you should deduct fixed cost in order to find EBIT. That is the marginal statement. So less fixed cost. How much is the fixed cost given? Fixed cost is 2 lakhs. So in respect of amount column within bracket 2 lakhs. In respect of amount column within bracket 2 lakhs. Now total it. Underline it. 3 lakhs minus 2 lakhs. Underline it 1 lakh. Below that 1 lakh. In respect of that 1 lakh, EBIT. EBIT. Mention it clearly that EBIT. If you are not mentioning it clearly, then they will assume it as EBT. Like examiner needs a good clarity of answers. That is, you should mention it. It's better to write earnings before interest and tax. But if you want to consume, like if you want to save time, you can write it as EBIT. So EBIT is 1 lakh. Below that EBIT, point number D. Point number D. Interest on debt. Interest on debt. What is the debt percentage? The total debt is 5 lakhs at the rate of 10% interest rate. So within bracket 5 lakhs into 10%. Interest on debt within bracket 5 lakhs into 10%. Amount column 50,000 within bracket. Amount column 50,000 within bracket. Now underline it. 1 lakh minus 50,000. 1 lakh minus 50,000. Underline it 50,000. Below that 50,000. In respect of that 50,000, EBT. EBT, earnings before tax. So what and all we have found? We have found what is contribution, and we have found what is EBIT, and we have found what is EBT. With this we can find all three formulas, right? What is degree of operating leverage? Contribution divided by EBIT. Degree of financial leverage, EBIT divided by EBT. And degree of combined leverage, contribution divided by EBT. That's all. Now you should substitute all three formulas. Degree of operating leverage. What is the degree of operating leverage? There are two formulas. That is percentage of change in percentage of change in EBIT divided by percentage of change in sales, or contribution divided by EBT. See, simply you should go down, ma'am. First is operating part. Next is financial part. So degree of operating leverage. Come to the operating part. Contribution divided by EBIT. Contribution divided by EBIT is the degree of operating leverage. Next, degree of financial leverage is EBIT divided by EBT. So EBIT divided by EBT, degree of financial leverage, and degree of combined leverage is combination of both. That is contribution divided by EBT from top to bottom. This is the formula for degree of all three leverages. So below that EBT, put statement number 2. Statement number 2. Point number 1, degree of operating leverage. The DOL is equal to, point number 1, DOL is equal to contribution divided by EBIT. Contribution divided by EBIT is equal to, what is the contribution given, which we found? 7 lakhs minus 10 lakhs. That is, 10 lakh minus 7 lakh. That is 3 lakhs. So is equal to 3 lakh divided by EBIT, which we found is 1 lakh. 3 lakh divided by 1 lakh is equal to 3:1. 3:1. Below that, point number 2. Below that, point number 2, degree of financial leverage, that is DOF, is equal to, that is not DOF, that is DFL. DFL, degree of financial leverage, DFL is equal to, what is the formula? EBIT divided by EBT, because financial part is this interest on debt. So this interest on debt only deals with DFL. So above and below should be divided. And same way, operating leverage, fixed cost plays important role. So above and below values should be divided. To understand the concept, I'm telling this, but you should remember the formulas. Degree of financial leverage, EBIT divided by EBT is equal to, what is EBIT? 1 lakh. What is EBT? 50,000. So 1 lakh divided by 50,000. 1 lakh divided by 50,000 is equal to 2:1. 2:1. Below that, point number 3, degree of combined leverage, DCL is equal to, it combines both. So contribution divided by EBT. Contribution divided by EBT is equal to 3 lakhs divided by 50,000. 3 lakhs divided by 50,000 is equal to 6:1. Is equal to 6:1. With this, we have found all the three leverages. Very easy. All the three leverages we found. That is operating leverage, contribution divided by EBIT, because fixed cost plays important role. So operating leverage is contribution divided by EBIT. Financial leverage is EBIT divided by EBT, because interest plays important role. And DCL is combination of both. That is contribution divided by EBT, because If you multiply both EBIT, denominator EBIT and numerator EBIT will get cancelled. So contribution divided by EBT, that is combined leverage. So below that statement number 3, what they have asked in the question, if the firm wants to double its EBIT, how much rise in sales would be needed on percentage basis? What is the formula for degree of operating leverage? Percentage of change in EBIT divided by percentage of change in sales. Here we know what is operating leverage, that is 3:1, and we know what is change in EBIT, that is 100%, because you need 100% of increase, that is doubling the EBIT. So with this we can find what is percentage of sales. So statement number 3, calculation of percentage of change in sales, required to double its EBIT, So below that, degree of operating leverage, that is DOL is equal to percentage of change in EBIT, percentage of change in EBIT divided by percentage of change in sales. If this percentage of change in sales goes to the left hand side, it becomes numerator, and this degree of operating leverage comes to the right hand side, it becomes denominator. What is degree of operating leverage? We found 3:1, that is 3. So percentage of change in sales is equal to, below that, percentage of change in sales is equal to, how much is the percentage of change in EBIT? 200, that is doubling. So suppose to now total EBIT is 100. If I want to double into 2, that is 200. So 200 divided by 100 into 100, that is 200%, minus percentage of change. So new percentage minus old percentage, 100 is equal to 100% change. So percentage of change is 100% divided by 3 is equal to 100% divided by 3. Below the percentage of change in sales is equal to 33.33%. 33.33%. With this we have completed problem number 2. Now moving on to problem number 4. Problem number 4, come to the question. The following information is available for XYZ and Co. What are the information available? EBIT is there, that is 11,20,000, and profit before tax, that is EBT, is 3,20,000. Fixed cost is 7 lakhs. Okay, and calculate the percentage of change in EPS if sales are expected to increase by 5%. See, they have given increase in sales is 5%. Then we need to find increase in EPS. Then what is the formula? Where EPS and sales are connected? Only in the combined leverage. So we should find what is degree of combined leverage. Then we can apply the degree of combined leverage formula, that is percentage of change in EPS divided by percentage of sales, to find the percentage of change in EPS. Okay, now you understood the problem. What they have given is EBIT. From that, tax we deduct, means they itself have given PBT, which means if we deduct this both, we will get what is tax. That is, sorry, what is interest. If we deduct this 11,20,000 and 3,20,000, we know what is interest. And from PBT, by dividing EBIT divided by EBT, we will get what is degree of financial leverage. So with this, we will move on to problem number 4. Come to the notes. Problem number 4. Take down problem number 4. Small Roman number 1. First we will find what is interest. How can we find interest? EBIT minus EBT. If we calculate what is interest, we can get interest is equal to EBIT minus EBT. After EBIT, we will deduct interest. Then we will get EBT. Here we have EBIT and EBT. Then the balance amount is interest. So EBIT minus EBT is equal to 11,20,000 minus 3,20,000 is equal to rupees 8 lakhs. So just calculate 11,20,000 minus 3,20,000 is equal to 3 lakhs. So interest amount is 3 lakhs. Done. Below that, see, we have EBIT, we have interest, we have EBT, and we have fixed cost. So EBIT plus fixed cost will get contribution. Just remember this: sales minus variable cost, you will get contribution. And from contribution, if you remove the fixed cost, that is deduct the fixed cost, you will get EBIT. Now we have EBIT and fixed cost. If we add both, we will get contribution. Reverse working. So now do the reverse working. Below that, small Roman number 2. Contribution is equal to EBIT plus fixed cost. Normally we will see contribution minus fixed cost is equal to EBIT. So here we have EBIT and fixed cost. If we add both, we will get contribution. That is reverse working. So contribution is equal to EBIT plus fixed cost is equal to 11 lakh 20,000 plus 7 lakh. 11 lakh 20,000 plus 7 lakh. So contribution is equal to 18 lakh 20,000. Contribution is equal to 18 lakh 20,000. Here we have contribution and we have PBT, that is EBT. With that we can find degree of combined leverage. No. Okay. Below that point number 3. Below that point number 3. DCL is equal to, that is degree of combined leverage is equal to contribution divided by EBT. Contribution divided by EBT. What is contribution? 18 lakh 20,000. And what is EBT? They have given 3 lakh 20,000. So 18 lakh 20,000. 18 lakh 20,000 divided by 3 lakh 20,000. Divided by 3 lakh 20,000. Here they have written 8 lakh, but it is 3 lakh 20,000. Don't copy it from notes. Wait for what I'm like saying, because there are some few mistakes in the while they have written. So like wait and don't just copy from the notes. Okay, contribution divided by EBT, that is 18 lakh 20,000 divided by 3 lakh 20,000 is equal to 5.687 is to 5. 5.687 is to 1. That is 5.687 is to 1. Degree of combined leverage is equal to 5.687 is to 1. So we have find what is DCL. What is the other formula for DCL? Percentage of change in EPS divided by percentage of change in sales. There are two formulas called DCL, that is contribution divided by EBT. The other one is percentage of change in EPS divided by percentage of change in sales. So here we know what is percentage of change in sales. So we should find what is percentage of change in EPS by using the DCL answer. That is, we have already found what is DCL. So below that point number 4, DCL is equal to percentage of change in EPS, divided by percentage of change in sales, divided by percentage of change in sales. Percentage of change in EPS divided by percentage of change in sales. Below that, 5.687 is equal to percentage of change in EPS divided by pi, because sales has increased by 5. So percentage of change in EPS divided by 5. So if you take the 5 to the left hand side, it will become numerator. So 5.687 into 5 is equal to 28.435. So change in below the change in EPS is equal to percentage of change in EPS equal to 28.44%. 28.44%. So with that we have completed problem number 4. Now moving on to problem number 7. Problem number 7. Just see the question. The following data is available for XYZ Limited. They have already given the marginal income statement, that is sales 2 lakh, variable cost is 60,000, that is at the rate of 30%. So remaining contribution is 1,40,000 less fixed cost, you will get EBIT. From that, if you deduct interest, you will get PBT. So here the PBT we have got is 35,000. With this table, we can find all the 3 leverages. How we will find? First, degree of operating leverage, contribution divided by contribution divided by EBIT, that is degree of operating leverage. Second, degree of financial leverage, EBIT divided by PBT. The third, degree of combined leverage, that is contribution divided by PBT. With this, we can find all 3 leverages. Okay. Now find out what they are asking us to find out. They are not asking us to find out only these 3 leverages, but they are giving something also. That is point number A. Using the concept of financial leverage, by what percentage will the taxable income increase if EBIT increased by 6%? See, they are asking, they are using the financial leverage, that is DFL, in order to find percentage of change in PBT if percentage of increase in EBIT is 6%. What is the formula for DFL? Percentage of change in EBIT divided by, percentage of change in PBT divided by percentage of change in contribution. What percentage will taxable income increase if EBIT is increased by 6%? So we can find what is percentage of increase in PBT. So next is using the concept of operating leverage, by what percentage will EBIT increase if there is 10% increase in sales. That is, what is the degree of operating leverage formula? First, using this table, we can easily find what is degree of operating leverage. And for finding what is the percentage of change in EBIT, the formula is percentage of change in EBIT divided by percentage of change in sales. So using that formula, we can easily find what is the percentage of change in EBIT. Using the concept of leverage, that is combined leverage, by what percentage will taxable income increase if sales increase by, what is the formula for degree of combined leverage? Percentage of change in EPS divided by percentage of change in sales. Also verify the results in view of above figures. That's all. Easy question, but they'll ask for 8 marks. So come to the solution. 3 things they have asked us to find, man. That is, using first we should find all 3 values, that is DFL, DOL and DCL. And using the 3 answers, we should find what is the percentage of change in taxable income, percentage of change in EBIT and percentage of change in taxable income for all 3 A, B, C. So now first come to the solution. Problem number 7. Come to the notes. Problem number 7. Small a. DFL is equal to, we are finding the answer for small a first. DFL, what is the formula for DFL? Using this table, how we can find DFL is equal to EBIT divided by PBT, that is EBT. We can call this profit before tax or earnings before tax also. We'll assume it as EBT itself, earnings before tax. So DFL is equal to EBIT divided by EBT. So what is EBIT? 40,000. EBT 35,000. So take down small a. DFL is equal to EBIT divided by EBT. EBIT divided by EBT is equal to 40,000 divided by 35,000. 40,000 divided by 35,000 is equal to 1.14:1. 1.14:1. Below that, small b. What they have asked us? They have asked us, that is percentage of EBIT increase is 6%. So what will be the increase in taxable income? So using this DFL formula itself, we can find now percentage of change in EBT divided by percentage of change in EBIT will be the formula for DFL. So below that, small b. No, it's not a small b. Just erase it. Just below that, DFL is equal to percentage of increase in EBT divided by percentage of increase in EBIT. Percentage of increase in EBT divided by percentage of increase in EBIT. So what is the percentage of increase in EBT? We don't know. What is percentage of increase in EBIT? We know it is 6% because they have given in the point number A. So below that, 1.14 is equal to percentage of increase in EBT divided by 6%. Percentage of increase in EBT divided by 6%. If this 6% goes to the left hand side, it becomes numerator. So below that, percentage of increase in EBT is equal to 6.64%. 6.64%. If there is increase in EBIT by 6%, then EBT will increase by 6.64%. 6.64%. That's all. This is point number A. Simple. We should find what is the answer for DFL. Then using that answer, we should find what is the percentage of change. That only is going to repeat the entire chapter. That's all. Honestly, what you should do in every problem is, first you should find what is DFL. Then using that, you should find either increase in EBT or increase in EBIT. That's all. So next, point number B. Using the concept of operating leverage, by what percentage will EBIT increase if there is 10% increase in sales? First, for this, we should find what is DOL. Then using the DOL, we should find what is percentage of change in EBIT. Okay, below that point number B, below that, small b, DOL is equal to contribution divided by EBIT. Contribution divided by EBIT. What is the formula for DOL? Contribution divided by EBIT. And what is for financial leverage? EBIT divided by EBIT. So now we know contribution divided by EBIT. Now substituting 1,40,000 divided by 40,000 is equal to 1,40,000 divided by 40,000. So 3.5:1. 3.5:1. So below that, again, DOL is equal to, don't put this, DOL is equal to, what is the formula for DOL? Another formula, percentage of change in EBIT divided by percentage of change in sales. Here they are given percentage of change in sales, increase in sales is 10%. So using that DOL formula, we can easily find what is percentage of change in EBIT. So below that, DOL is equal to, DOL, that is degree of operating leverage, is equal to percentage of change in EBIT divided by percentage of change in sales. For all DOL, we should only see from sales to EBIT, and for DFL, we should only see from EBIT to EPS, and for combined, you should see from sales to EPS. That's all. This is the three techniques. So DOL, percentage of change in EBIT divided by percentage of change in sales. We found that that is DOL is 3.5. So 3.5 is equal to percentage of change in EBIT divided by 10%. Divided by 10. Percentage of change in EBIT divided by 10. If 10 goes to the left hand side, it becomes numerator. So percentage of change in EBIT is equal to 10 into 3.5, that is 35%. That is 35%. How can we cross verify it? See, if percentage of change in EBIT is 35%, if there is percentage of change in sales is 10%. Simple. With this particular concept, we have found that if there is 10% increase in sales, there will be 35% increase in EBIT. So cross verification we should do. That is, we should increase the sales by 10%, so that we can find that whether EBIT is increasing by 35% or not. So below that, note that is cross verification. Underline it. Cross verification. Below the two column are particulars, amount. Particulars and amount. In particulars, below that, revise the sales value 2 lakh into 110%, because there is a 10% increase in sales. We are cross verifying it. They itself have given 10% increase in sales. We have found that if there is 10% increase in sales, there will be 35% increase in EBIT. First, do 10% increase in sales. Revise sales value. So 2 lakhs into 110%. Amount column 2,20,000. 2,20,000. How much is the percentage of variable cost? 30%. So minus variable cost. How much is the sales? Within bracket 2,20,000 into 30%. 2,20,000 into 30%. 66,000 within bracket. Amount column 66,000 within bracket. So below that 1,54,000. Underline it, 1,54,000. What is this 1,54,000? Sales minus variable cost is contribution. In respect of particulars column, contribution. In respect of that 1,54,000 contribution. Below that, less fixed cost. Fixed cost, irrespective of the change in sales, it will be fixed. We know that the concept of fixed cost is it will always be fixed in total. So less fixed cost, amount column within bracket 1 lakh. Amount column within bracket 1 lakh. Now underline it. 1,54,000 minus 1 lakh. Amount column put 54,000. Amount column put 54,000. So what is this 54,000? This is revised EBIT. If you deduct contribution minus fixed cost, you will get EBIT. So 54,000. Existing EBIT is 40,000. So 54,000 minus 40,000. How much you are getting? 54,000 minus 40,000. You are getting 14,000. So 14,000 divided by 40,000 into 100. That is 35%. So the percentage of change in EBIT is right. So in respect of that 54,000, revise the EBIT. Below that, first arrow mark, increasing EBIT is equal to 54,000 minus 40,000. Presently, revised EBIT is 54. Existing EBIT is 40,000. So 54,000 minus 40,000 is equal to 14,000. So below that, percentage of second arrow mark, percentage of increase in EBIT is equal to 14,000 divided by what is the existing EBIT? 40,000 into 100. 14,000 divided by 40,000 into 100 is equal to, calculated, 14,000 divided by 40,000 into 100 is equal to 35%. So it is right that percentage of change in EBIT is 30% if there is 10% increase in sales. So now, below that, what is the third thing? C. That is point number C, what they have given using the concept of leverage, that is combined leverage. If they have given only leverage, it is combined leverage. By what percentage will the taxable income increase if sales is increased by 6%? Before some 10% increase in sales, what EBIT will increase they ask. But now they ask with 6% increase in sales, how much the taxable income, that is EBT will change. So we should use combined leverage. We should understand the question before choosing the particular leverage. Here, same percentage of increase in sales, but they asked us to find what is taxable income. Taxable income is nothing but EBT. EBT is next to taxable income. That is, after EBT, you will pay tax. So that tax amount will be calculated on the EBT. So that is the taxable income. So what will be the percentage of taxable income means they are asking us to find percentage of change in EBT. So we should use combined leverage. Below that, point number C. Below that, point number C. Computation of combined leverage. Computation of combined leverage. First, we should find what is combined leverage. Then, using that combined leverage formula, we should find what is percentage of change in EBT. Sorry, EBT. So first, below that small a, DCL is equal to, what is the formula for DCL? Top to bottom, that is contribution divided by EBT. So contribution to DCL is equal to contribution divided by EBT. Simple. DOL is contribution divided by EBIT. DFL EBIT divided by PBT. And for DCL, contribution divided by EBT as a whole. So DCL is equal to contribution divided by EBT. What is contribution? 1,40,000 is equal to 1,40,000 divided by EBT is 35,000. 1,40,000 divided by 35,000 is equal to 4:1. 4:1. So DCL is 4:1. So below that, point number B, DCL, that is DCL is equal to percentage. What is the formula? Another formula for DCL, percentage of change in EBIT divided by percentage of change in sales, or we can even use percentage of change in EPS divided by percentage of change in sales, because the number of shares are not going to vary. After EBT, we will deduct tax and then we will calculate PAT. That PAT belongs to EPS. So percentage DCL formula, that is degree of combined leverage formula, can be taken as percentage of change in EBT divided by percentage of change in sales. So below that, 4 is equal to, what is the combined leverage? 4. So 4 is equal to percentage of change in EBT divided by 6. Percentage of change in EBT divided by 6. Below that, percentage of change in EBT is equal to 4 into 6, that is 24%. Percentage of change in EBT is equal to 24%. Now we should cross verify it. They itself has asked us to verify the results. So this cross verification is part of answer. It is not something we are doing in order to check whether the answer is right or not. But they have asked us also verify the results. So it is form part of answer. So below that, cross verification, underline it. Below the 2 columnar table, particulars and amount. So below the particulars, what is the revised sales value? How much is the increase in sales? 6%. So revise the sales value. Below the particulars, revise sales value within bracket 2 lakh into 6%. 2 lakh into 106%. Amount column 2,12,000. Amount column 2,12,000. Below that, less. What is the variable cost percentage? 30%. For variable cost, you should always take percentage. For fixed cost, you should always take amount. That is how it works, because variable cost will vary with the number of units, percentage of change in sales. But whereas fixed cost in total won't vary with change in sales. Fixed cost will be fixed in total. So variable cost at 30% within bracket 2,12,000 into 30%. 2,12,000 into 30%. Amount column 63,600 within bracket. 63,600 within bracket. Now total it 1,48,400. Now underline it and total it 1,48,400. 1,48,400 in respect of that contribution. Below that, less fixed cost. Less fixed cost. How much is the fixed cost? 1 lakh. So less fixed cost, amount column 1 lakh within bracket. Amount column 1 lakh within bracket. So 1,48,400 minus 1 lakh. Underline it. Amount column 48,400. 48,400. So that is revised EBIT. Revised EBIT. From the revised EBIT, less interest, less revised EBIT. In respect of that 48,400, revised EBIT. Below that, less interest within bracket, amount column within bracket 5,000. Less interest, amount column within bracket 5,000. Now total it. 48,400 minus 5,000. Amount column 43,400. Amount column 43,400. So this is the EBT. So in respect of that 43,400, revise EBT. Now we should calculate what is the percentage of increase in EBT. So existing EBT is 35,000. Present EBT is 43,400. So below that increasing EBT is equal to now calculate it, 43,400 minus 35,000. How much is increase in EBT? 8,400. Increase in EBT is equal to 8,400. Below that is equal to, that is percentage of increase in EBT is equal to 8,400 divided by 35,000 into 100. So you are getting 24% is equal to 24%. What we have calculated 24%. So cross verification is also 24%. So the given the found answer for this percentage of change in EBT is right. So with this we have completed problem number 7. Now moving on to problem number 1. The problem number 1, examination problem. So first we'll read the question. Calculate the degree of operating leverage, degree of financial leverage, and degree of combined leverage for the following firms and interpret the results. Okay, they have asked us to calculate all three leverages. Simple. And what and all data they have given within table: firm K, firm L, firm M, K, L, M, three firms. First, output in units. What is the total number of outputs? Then fixed cost. What is the different fixed cost? And variable cost per unit they have given. And interest on borrowed funds, that is 4,000, 8,000, and firm M didn't borrow any interest, so their financial leverage will be 0. If there is no interest, financial leverage will be 0. And what is degree of operating leverage? It will be same as degree of combined leverage. So next is selling price per unit 0.6 by 0.1. So with this we can easily find, see, output into selling price will get sales value, minus what is variable cost into selling price, output will get variable cost. From that we'll get contribution. Or else if we deduct selling price per unit minus variable cost per unit, we'll get contribution per unit. Contribution per unit into output will get total contribution. From that if we deduct fixed cost, we'll get EBIT. So from EBIT, if we deduct interest, we'll get EBT. From that we can easily calculate all three formulas. Simple. Okay, come on, put the heading. Problem number 1. Statement number 1, marginal income statement. Statement number 1, marginal income statement. This particular table, she has a little bit didn't give any calculations. So what we will do is we'll just change the format. That is same format. We'll just change the values so that it will be easily understandable. So statement number 1, marginal income statement. Below that 4 columnar table. First column particulars. Second column K. Third column L, and last column M. Particulars K, L, and M. K, L, and M. 3 forms. Below that small a. Below that particulars, put small a. Selling price per unit. Write it carefully. Selling price per unit. What is selling price per unit for K? In respect of K, put 0.6. Point number A. Selling price per unit. In K, put 0.6. For L, 5. For L, 5 rupees per unit. And for M, it is 0.1 per unit. So this is selling price per unit. Below that small b, less total variable cost. They have given total variable cost. We should put variable cost per unit. Small b less variable cost per unit. What is variable cost given? For K it is 0.2. For K within bracket 0.2. For L within bracket 1.5. And for M within bracket 0.02. Now deduct it. Now underline all 3 columns K, L, M. Below that small b, put small c contribution. Within bracket A minus B. Contribution within bracket A minus B. And what is for K? Selling price per unit is 0.6 minus what is the variable cost per unit? 0.2. So in respect of contribution for K, 0.4. And for L, and for L 0.5 minus 1.5, that is 3.5. 5 minus 1.5, contribution per unit is 3.5. In respect of L, 3.5. And for M, 0.1 minus 0.02. 0.1 minus 0.02. In respect of L, M contribution is 0.08. Contribution per unit is 0.08. So with this point number C, that is contribution per unit, we finish. Below that, small d, output in units. Output in units. For K 60,000, for L 15,000, and for M 1 lakh. 60,000 for K, and for L 15,000, and for M 1 lakh. 60,000, 15,000, 1 lakh. Now multiply it. Below that, small e, total contribution. Total contribution. Now totally multiply contribution per unit into output. You will get for K 24,000, for K 24,000, for L 52,500, for L 52,500, and for M 8,000, and for M 8,000. So with that we have found total contribution, that is point number E, total contribution. From that, below that minus, below that small f minus fixed cost, minus fixed cost. How much is the fixed cost they have given? 7,000, 14,000 and 1,500. Minus fixed cost, all three columns within bracket 7,000, within bracket 7,000, for L within bracket 14,000, and for M within bracket 1,500. 1,500. Below that, small g, EBIT. Small g, EBIT. Now what is EBIT? Contribution minus fixed cost is EBIT. So E minus F, within bracket E minus F, EBIT within bracket E minus F. For K, it is 24,000 minus 7,000 is 17,000. For L, 38,500. And for M, 6,500. 17,000, 38,500 and 6,500. That is EBIT. Below that, small h less interest, EBIT. From that we should deduct interest to get EBT. EBIT minus interest will get EBT. From EBT, if we deduct tax, we will get PAT. That is the format. So EBIT, below that minus interest. For K it is 4,000. For K it is 4,000 within bracket, and for L it is 8,000 within bracket. And for L within bracket 8,000. For M there is no interest on borrowed funds, so nil. Now totally. Below the small I, EBT is equal to EBT. Therefore EBT. Now deduct it. 17,000 minus 4,000, that is EBT for K is 13,000. EBT is 13,000 for K. 38,500 minus 8,000, that is 30,500 for L. And for M there is no interest on borrowed funds, so 6,500. 13,000, 30,500 and 6,500. That is earnings before tax, EBT. Now below that small Roman number, that is below that statement number 2, we should find out leverages for all three firms. You can use any format, but this format it will be easy to complete in less time. Okay, statement number 2, calculation of leverage. Below that capital A, particulars, not capital A, below that particulars KLM, below that particulars, 4 column table, first column particulars, second column K, third column L and fourth column M. Below that particulars, capital A, DOL, that is degree of operating leverage. Below that small Roman number 1, contribution. Below the DOL, small Roman number 1, contribution. What is the contribution for all three firms? Copied. 24,000, 52,500 and 8,000. For K 24,000, L 52,500 and for M 8,000. That is contribution. Small Roman 1 contribution. 24,000, 52,500 and 8,000. Below that, small Roman number 2. What is the DOL formula? Contribution divided by EBIT. For DFL, EBIT divided by EBT, and for DCL, contribution divided by EBT. So these are the three formulas. So small Roman number 2, EBIT. What is the EBIT? 17,000, 38,500 and 6,500. EBIT 17,000 for K, 38,500 for L, and 6,500 for M. 6,500 for M. Now below that EBIT, small Roman number 3, DOL. Small Roman number 3, DOL is equal to, within bracket, small Roman number 1 divided by small Roman number 2. Small Roman number 1 divided by small Roman number 2. So what is the small Roman number? 24,000 divided by 17,000. That is 1.41:1. In respect of K, 1.41:1. That is degree of operating leverage. 1.41:1. And for L, 1.36:1. 52,500 divided by 38,500. That is 1.36:1. And for M, 8,000 divided by 6,500. That is 1.23:1. This is 1.23:1. So next is leave one line gap. Capital B. Next we should find degree of financial leverage. Degree of financial leverage. DFL. Capital B in respect of particulars column, DFL. Below that, small Roman number 1. What is DFL formula? EBIT divided by EBT. So small Roman number 1, EBIT. Now just copy the EBIT. 17,000, 38,500 and 6,500. 17,000, 38,500 and 6,500. And below that, small Roman number 2, EBT. EBT. What is EBT we have found? 13,000, 30,500 and 6,500. So copy it. For K it is 13,000. And for L 30,500. For L 30,500. And for M it is 6,500 because there is no interest on borrowed funds. Same 6,500. Below that, small Roman number 3. DFL is equal to small Roman number 1 divided by small Roman number 2. Just calculate it. 1.31:1. 1.26:1. For K it is 1.31:1, and for L it is 1.26:1, and for M it is 1:1, because there is no degree of that is, there is no interest cost. So DFL is 1:1. 1:1. So below that, leave one line gap. Small Roman number C. That is DCL, degree of combined leverage. Below that, small Roman number 1, contribution. What is the DCL formula? Contribution divided by EBT. The top and the bottom. That is, see, top is contribution, EBT is below. So contribution divided by EBT is DCL, and contribution divided by EBIT is DOL. EBIT divided by EBT is DFL. Remember this. That's all. 3 formulas. If you remember any sum from this leverage analysis, you can easily answer. So small Roman number 1, contribution. Just copy the contribution. What is the contribution? For K it is 24,000. And for L it is 52,500. And for M it is 8,000. Below that, small Roman number 2. EBT. What is EBT given? 13,000 for K. For K it is 13,000. And for L it is 30,500. And for M it is 6,500. Now calculate. Below that, small Roman number 3, DCL is equal to, within bracket, small Roman number 1 divided by small Roman number 2. So for in respect of K, 1.85:1. 1.85:1. In respect of L, 1.72:1. 1.72:1. And in respect of M, 1.23:1. 1.23:1. So this is degree of combined leverage. With this, we have calculated all three leverages and for all three firms. So this is problem number 1. Okay, done. With this, we are moving on to problem number 3. Problem number 3. Okay. First, we'll read the question. Xerox Corporation has estimated that for new product, its break-even point is 2000 units. That is, if it achieves 2000 units, then it can earn profits up to fixed cost. That is, break-even point is nothing but the total profit earned. That is, it will match the fixed cost. So that is break-even point. There will be no loss, no profit. If the items are sold at 14 per unit, only if it is sold at 14 per unit, 2000 units get sold means then they will achieve break-even point. The costing accounting department has currently identified variable cost of 9 per unit. Variable cost is 9 per unit. Calculate the degree of operating leverage for sales volume of 2500 units and 3000 units. They are asking us to calculate operating leverage at the sales volume of 2500 and 3000 units. Okay. What do you differ from the degree of operating leverage at the sales volume of 2500 units and 3000 units and the difference, if any? Very easy. Very easy to. One second. So they have asked us to calculate what is the break at break even point, that is 2000 units, it is 14 per unit, and calculate the degree of operating leverage for 2500 units and 3000 units and how they are differing. So that is what they have asked us in the question. So now moving on to solution. Problem number 3. Problem number 3. Statement number 1. Calculation of total fixed cost. Calculation of total fixed cost. Below that, point number 1. Point number 1. At break even point, total contribution generated by the entity will be equal to fixed cost. That is, see, whatever the profit you are earning, that contribution you are earning, that is equal to fixed cost. That is the break even point. Anything more than break even point will be profits. Anything less than break even point will be loss. So that is called break even point. And whatever the contribution you are getting till the break even point, that is called fixed cost. So at break even point, total contribution generated by entity will be exactly equal to fixed cost. With this, we can easily find fixed cost now. So fixed cost is equal to BEP in units into contribution per unit. BEP in units into contribution per unit. That is equal to 2000 into 5. 2000 into 5 is equal to 10,000. Fixed cost is equal to 10,000. So fixed cost is equal to, below that, fixed cost is equal to BEP in units into contribution per unit. See, at BEP level, whatever contribution you are earning, that is equal to fixed cost. So when you are calculating, see, simple man, what is mean by BEP? No profit, no loss. Okay. So contribution minus fixed cost, what should come below? That is EBIT. EBIT should be 0. So contribution minus fixed cost, if it is coming 0, means contribution and fixed cost are same. So that is what they have explained in this point. Contribution will be equal to fixed cost. So how to find this contribution? Contribution per unit, first you should find, that is 14 minus 9, that is 5 is the contribution per unit, into what is the total number of units that is to be sold in order to achieve break even point, 2000. So 2000 into 5, that is 10,000 is the contribution at 2000 units, whereas that is the fixed cost also. So fixed cost is equal to BEP in units, BEP break even point in units, that is total number of units that is to be sold to achieve BEP into contribution per unit. So is equal to 2000 into 5. 2000 into 5 is equal to 10,000. Below that, note, contribution per unit is equal to selling price per unit minus variable cost per unit. You know that selling price per unit is 14 and variable cost per unit is 9. If you deduct both, that is contribution per unit. So note, contribution per unit is equal to selling price per unit minus variable cost per unit. That is equal to 14 minus 9 is equal to 5. Below that, statement number 2, marginal income statement. Now we know what is fixed cost, we know what is selling price per unit, and we know what is variable cost per unit. With this, we can easily find what is EBIT. So they have asked us only degree of operating leverage. So what is the formula for degree of operating leverage? Contribution divided by EBIT. So we can only find it with the contribution and EBIT itself. We don't want any interest rate. So below that, statement number 2, marginal income statement. Below that marginal income statement, put 3 column table. That is, first column particulars, second column at 2500 units, and third column at 3000 units. That is not 25,000 units, that is 2500 units and 3000 units. Second column is 2500 units, third column at 3000 units. Below that particular small a, sales value at 14 per unit. Sales value at what is selling price? 14. So sales value at 14 per unit. In respect of 2500 units, 14 into 2500, that is 35,000. In respect of 2500 units, second column 35,000, and last column 3000 into 14 is equal to 42,000. 3000 into 14, what is that? 42,000. Below that, small b minus variable cost at rupees 9 per unit. Below that, small b less variable cost at rupees 9 per unit. So what is the number of units? 2500 into 9. So in respect of second column, that is 2500 units, variable cost within bracket 22,500. Within bracket 22,500. And last column 3000 into 9. 3000 into 9 within bracket 27,000. Within bracket 27,000. So now total it. Second column 35,000 minus 22,500. Underline it, 12,500. 12,500. And third column, that is last column, 42,000 minus 27,000. 42,000 minus 27,000. Put 15,000 within bracket. That is underline it, 15,000. 15,000. In respect of 12,500 and 15,000, put small c contribution. Small c contribution within bracket a minus b. So we have easily found what is contribution, because sales value we know by multiplying it with 14 per unit, that is selling price per unit, and variable cost we know by multiplying it with 9 per unit. So sales value minus variable cost will get contribution, a minus b. 35,000 minus 22,500, that is 12,500, and the 42,000 minus 27,000, that is 15,000. So below that, small d, below that contribution, small d, less fixed cost. Less fixed cost. How much is the fixed cost which we found in statement number 1? That is 10,000. So less fixed cost under both the column, 10,000 within bracket. 10,000 within bracket. Now underline it. Both the column underline it. 12,500 minus 10,000, that is 2,500. Put 2,500, and 15,000 minus 10,000, put 5,000. 5,000. 2,500 and 5,000. So in respect of the 2,500 and 5,000, put small e EBIT. Small e EBIT within bracket c minus d. Within bracket c minus d. Now calculate the DOL for both the units. Below that EBIT, write down the formula first. DOL, that is degree of operating leverage, is equal to contribution divided by EBIT. Contribution divided by EBIT. In respect of second column, that is 2,500 units, put 12,500 divided by 2,500. 12,500 divided by 2,500. And in respect of 3,000 units, put 15,000 divided by 5,000. 15,000 divided by 5,000. So below that, calculate it. 12,500 divided by 2,500, that is 5:1. Below that, 5:1. Below the 12,500 divided by 2,500, write 5:1. And for last column, 15,000 divided by 5,000, put 3:1. 3:1. In respect of that 5:1 and 3:1, put DOL, degree of operating leverage. Degree of operating leverage. Now see, degree of operating leverage is 5:1 under 2,500 and 3:1 under 3,000 units. So below that, write down comment. Below that, take down comment. Under comment, first arrow mark, at 2,500 units, at 2,500 units, degree of operating leverage is 3:1. Degree of operating leverage is 3:1. It indicates that sales increase by 1%. It indicates by sales increase by 1%. Then EBIT will increase by 5%. 5:1 is nothing but, suppose you are currently selling 100 units. If it increase by 1%, that is, if it increase by 101 units, your profit will increase by 5%. That is what it is indicating. This degree of operating leverage, what it is indicating is, for every 1% increase in sales, what is the number of percent increase in EBIT? Here it is 5:1, DOL is 5:1. So, it indicates that if sales increase by 1%, if sales increase by 1%, then EBIT will increase by 5%. EBIT will increase by 5%. Now below that, second arrow mark, in the given situation, increase in sales is rupees 7,000 is due to 20% increase in existing sales of unit. Wait a minute. They are not asked just anything except this 2,500, 3,000. So this form part of some other answer. What do you differ from degree of operating leverage at sales volume of 2,500 and units of 3,000 units, and their difference, if any? So the problem number 3 has got over here itself. In the previous batch, there was some other additional question which was there, so that they have answered this. 2,000 units. So 2,000 into 14. What is 2,000 into 14? That is 28,000. And there is increase in 500 units. So 500 into 14. So that is 7,000. So okay, there has been increase in 500 units. 1,000 is due to 20% increase in existing sales. So existing sales is okay, right? So percentage of change in EBIT, DOL. Percentage of change in DOL is into percentage of change in EBIT divided by percentage of change in sales. So percentage of change in sales is equal to DOL is 5% and percentage of increase in 100%. So revised EBIT should be 2,500 into 200%, that is 5,000. Okay. They asked us one more question, which is not here, which is not there in this material, which they have asked us to cross verify. Only the comment should be, take down one more comment. Take down one more comment. At 3,000 units, DOL is 3:1. DOL is 3:1. It indicates that it indicates that sales increased by 1%. Sales increased by 1%. Then EBIT will increase by 3%. EBIT will increase by 3%. Okay. With that, we have completed problem number 3. Now moving on to problem number 5. Problem number 5. Here they are asking us to calculate DOL, DFL. That's all. But using all the values, we should find what is DOL and what is DFL. That is the calculation required here. Okay. Now now we'll move on to problem number 5. X and Co has 3 financial plans: Plan A, Plan B, and Plan C. Calculate the operating and financial leverage for the firm on the basis of following information, and also find out highest and the lowest of combined leverage. They are asking us to find out highest and lowest of combined leverage for each plans. Okay, Plan A, Plan B, Plan C, and there are 3 plans. X and Co has 3 financial plans. So below that, what they have given is total production is 800 units, selling price is 15, variable cost is 10, then contribution is 5. Fixed cost at situation. There are 3 plans: Plan A, Plan B, Plan C for financial leverage. That is mix of equity and debt. There are 3 plans, and fixed cost also there are 3 situations. That is situation A, situation B, situation C. So there are 3 fixed cost situations and 3 financial plans. So 3 into 3, there are 9 situations, 9 calculation of combined leverages. Okay, so that is what we should calculate in the problem number 5. So now come to the notes. They have asked us to calculate highest and the lowest combined leverage. First, we should calculate what is degree of operating leverage, then degree of financial leverage, then degree of combined leverage. Okay. First, statement number one. Problem number 5. Statement number 1. Calculation of contribution. Calculation of contribution. So first we should calculate contribution in order to calculate EBIT, so that we can calculate all the other leverages. So below the 2 column table, first column particulars, second column amount. First column particulars, second column amount. Below that particular small a, selling price per unit. Selling price per unit, amount column rupees 15. Amount column 15 rupees. Below that small b, variable cost per unit rupees 10. Variable cost per unit rupees 10. So total it 15 minus 10 will get 5. So below that small c, contribution per unit. Below that small c, contribution per unit, amount column rupees 5. Contribution per unit rupees 5. So below that small d, sales in units. Sales in units, small d, sales in units, amount column put 800. Total production is 800, which they are given here. So 800. Now total it 5 into 800, underline it, 4,000 rupees. 5 into 800, 4,000 rupees. In respect of that 4,000 rupees, write down small e, total contribution. Small e, total contribution. So within bracket C into D. Within bracket C into D. So we have calculated total contribution, that is 4,000 rupees. So now below that small row number 2, below that statement number 2, calculation of degree of operating leverage. Calculation of degree of operating leverage. See, for operating leverage, what are the two requirements? EBIT and contribution. What is the formula for DOL? Contribution divided by EBIT. So first we need what is contribution, then what is EBIT. So here there are 3 situations. For under 3 situations, there are 3 fixed costs. That is, for situation A it is 1,000, and for situation B it is 2,000, and for situation C it is 3,000. Okay. First, statement number 2, calculation of degree of operating leverage DOL. Below that 4 columnar table. First column particulars, second column A, third column B, and fourth column C. Particulars A, B, and C. Below that particular small a, contribution. Below the particular small a, contribution. All 3 columns put 4,000 rupees. 4,000, 4,000, and 4,000. Below that contribution, small number B. Below the small b, fixed cost. What is the fixed cost under 3 situations? 1,000, 2,000, and 3,000. So under capital A, 1,000 within bracket, and under capital B, 2,000 within bracket, and under C, 3,000 within bracket. 1,000 within bracket, 2,000 within bracket, and 3,000 within bracket. That is fixed cost. Now total it 4,000 minus 1,000, underline it 3,000, and 4,000 minus 2,000, underline it 2,000, and last column 4,000 minus 3,000, underline it 1,000. Underline it 1,000. So EBIT is 3,000, 2,000, and 1,000. So with this we can easily find what is degree of operating leverage. Below that small c. So first, in respect of the 3,000, 2,000, and 1,000, put EBIT. Put EBIT. That is small c. Small c EBIT. Below that small d, DOL. Small c, small d, DOL. Within bracket, contribution divided by EBIT. Within bracket, contribution divided by EBIT. In respect of A, what is contribution? 4,000. What is EBIT? 3,000. So 4,000 divided by 3,000, that is 1.33:1. In respect of A, 1.33:1. In respect of B, 4,000 divided by 2,000, that is 2:1. 2:1. In respect of C, 4,000 divided by 1,000, that is 4:1. 4:1. So DOL 1.33:1, 2:1, and 4:1. That is degree of operating leverage. And next is degree of financial leverage. Degree of financial leverage. Statement number 3. Below that statement number 3. Calculation of degree of financial leverage within bracket DFL. Calculation of degree of financial leverage within bracket DFL. Below that capital A. hyphen situation A, underline it. Situation A, underline it. Below that situation A, 4 columnar table. First column particulars, second column A, third column B, and last column C. 4 columnar table, particulars A, B, and C. So what is the formula for DFL? EBIT divided by EBT. We know that the formula for DFL is EBIT divided by EBT. So below that particular small Roman number 1, EBIT. Small Roman number 1, EBIT. So what is the EBIT which we calculated? Just copy the EBIT. 3000, 2000, and 1000. But see, for situation A, that is, there is 3 fixed cost situations, whereas 3 capital structure situations. Here, the situation A belongs to this plan A. That is, see, under situation A, fixed cost, if fixed cost is 1000 rupees, okay. If fixed cost is 1000 rupees, EBIT is 3000 rupees. And for this EBIT 3000 rupees, you should calculate the financial leverage under 3 plans. You understand? And for this EBIT, that is this fixed cost for 2000, the EBIT is 2000. For this 2000, you should calculate 3 capital structures. That is plan A, plan B, and plan C. So that is how you should calculate degree of financial leverage. So it will come totally 9 financial leverages. So particulars, plan A, plan B, and plan C. Below that, small Roman number 1, EBIT. Under situation A, what is EBIT? 3000 rupees. Under situation A, this is situation A, this is plan A. So situation A, what is EBIT? 3000 rupees. So under 3 columns, put EBIT 3000, 3000, and 3000. 3000, 3000, 3000. Below that, small number 2, interest at the rate of 12%. Here they have given 12% debt and equity capital. So 12% debt under plan A is 5000, 2500, and 7500. So interest at the rate of 12% under plan A, 5000 into 12%, what is that? 6000 within bracket 6000 under plan A within bracket 6000. Where is that drop? This one is within bracket 6000. So next is plan B. How much is the plan? 2500 into 12%, that is 300 within bracket 300. For plan B, interest is 300. Sorry, 300. And plan C, 7500 into 12%, that is 900 within bracket 900. For situation A, that is when EBIT is 3000. For situation A, what is the DFL under all 3 plans? Plan A, plan B, and plan C. Situation A, fixed cost is 1000. Under situation A, fixed cost is 1000. EBIT is 3000. Under that EBIT is 3000. That is situation A. There are 3 plans: plan A, plan B, and plan C. Under these 3 plans, we should calculate DFL. So EBIT minus interest. Below that, small Roman number 3. What is EBT? Small Roman number 3. Under particulars, EBT. Now totaling 3000 minus 600. Amount column, that is underline it, 2400. Under plan B, 3000 minus 300. Underline it, 2700. And plan C, 3000 minus 900. Underline it, 2100. Underline it, 2100. Below that, small Roman number 4. DFL is equal to small Roman number 1 divided by small Roman number 3. Small Roman number 1 divided by small Roman number 3. So under plan A, 3000 divided by 4000, 3000 divided by 2400. Under plan A, 1.25 is to 1. 1.25 is to 1. Under plan B, 3000 divided by 2700. Then 1.11 is to 1. Plan B, 1.11 is to 1. And plan C, 3000 divided by 2100. 1.43 is to 1. 1.43 is to 1. Next, we have found what is DFL if fixed cost is 3000. So under situation A, fixed cost is 1000, man. Okay, fixed cost is 1000 rupees. If fixed cost is 1000 rupees, EBIT, what EBIT we earned is 3000 rupees. And for the 3000 rupees, under each plans we should calculate what is DFL. Plan A, plan B, plan C. There are 3 situations of fixed cost and 3 situations of plan A, plan, that is plans of mix of capital structure. 3 into 3 shortly 9 leverages we can find. That is for degree of financial leverage we can find 9. Okay. Now under situation here, that is fixed cost 1000, we have calculated all three degree of financial leverages. That is plan A, plan B, and plan C. And below that, capital B, below that leave one line gap, capital B, situation B. Situation B within bracket, situation B, below that 4 columnar table. First column particulars, second column A, third column B, and last column C. First column particulars, second column A, third column B, and last column C. Under particulars, small room number 1, EBIT. What is the situation B, EBIT? 2000 rupees. See what we have calculated EBIT under situation B. Situation B, EBIT is 2000 rupees. So all three columns put 2000. All three columns put 2000. Below the small room number 2, interest at the rate of 12%. So interest will remain the same irrespective of a change in fixed cost situations. So 12% into 5000, that is 600 within bracket, interest at the rate of 12%. Plan A 600, plan B 300, and plan C 900. 600, 300, and 900, all three within bracket. Now below that small room number 3, EBT, small room number 3 EBT within bracket 1 minus 2, small room number 1 minus small room number 2. So 2000 minus 600 is 1400, underline it 1400. And under plan B 2000 minus 300, that is 1700. And under plan C 2000 minus 900, that is 1100. Below that small room number 4, degree of financial leverage is equal to small room number 1 divided by small room number 3. Small room number 1 divided by small room number 3. So what is degree of financial leverage? EBIT divided by EBT. Now total it. 2000 divided by 1400. Under plan A, that is 1.43:1. Under plan A 1.43:1. Under plan B 1.18:1. And under plan C 1.82:1. 1.43:1, 1.18:1, and 1.82:1. Below that, leave one line gap. Now situation C. What is situation C? That is fixed cost of 3000. When fixed cost is 3000, EBIT is 1000. So we have calculated EBIT is 1000 under situation C. So we have to calculate what is the DFL under three situations. So situation C. Below that capital C, situation C, underline it. Below that situation C, 4 columnar table. First column particulars, second column A, third column B, and last column C. Particulars A, B, C. Particulars A, B, C. Below that particulars, small room number 1, EBIT. What is the EBIT under situation C? 1000. So all three columns record 1000. Below that, small room number 2, interest at the rate of 12%. So copy the interest from the above table. That is 600, 300, 900 within bracket. Plan A 600 within bracket, plan B 300 within bracket, and plan C 900 within bracket. Now total it. Below that, small room number 3, EBT. Small room number 3, EBT. So 1000 minus 600 is 400 under plan A, and plan B 1000 minus 300 is 700, and plan C 1000 minus 900 is 100. Below that, small room number 4, DFL is equal to small room number 1 divided by small room number 3. Small room number 1 divided by small room number 3. So calculate it. 1000 divided by 400, that is 2.5:1. 2.5:1. 1000 divided by 700, 1.43:1. And 1000 divided by 100, 10:1. So all three A, B, C is A is 2.5:1, B is 1.43:1, and C is 10:1. So two things we should understand here. Okay, one is here they have mentioned fixed cost 3 situations and capital structure 3 situations. Without understanding that, what they will do is for situation N, plan A they will mix off. Under fixed cost they will use this plan A capital structure. For situation B they will use this plan B capital structure. It is not the case. Under situation A there are 3 capital structures. So 3 into 3 is 9 degree of combined leverage you should get. Okay, so don't think that under situation A and plan A are same, situation B and plan B are same. It is not the case. Situation A, B, C and plan A, B, C. There are 3 situations, and for each situation there are 3 plans. So totally 9 plans are there. Okay, so this is what point number 1. And point number 2 is degree of combined leverage can be calculated using either by dividing contribution divided by EBT or by multiplying degree of operating leverage into degree of financial leverage. As I told in the beginning itself, degree of combined leverage is equal to degree of operating DOL into DFL. So that is what we are going to do here. If we do the direct calculation, it will take time. So instead of that, we have multiplied DFL into DOL so that we will get easily all the DCL values. So below that, statement number 4. Statement number 4, calculation of DCL, that is degree of combined leverage, within bracket DFL into DOL, within bracket DFL into DOL. Below that, 4 columnar table. 4 columnar table, situation, right? Situation slash plan. Situation, put an arrow mark right hand side. Situation, put an arrow mark right hand side. Below that situation, write plan, put an arrow mark downwards. So situation, 3 columnar table, A, B, C. Situation A, B, C on the right hand side. And below that plan also 3 rows, A, B, C. A, B and C. So this is the table of DCL, that is degree of combined leverage. What you should find is under situation A and plan A, what is DCL and DOL? Sorry, DFL and DOL. You should multiply both and you should get what is the DCL for plan A and situation A, and what is the DCL for plan B, plan A and situation B, and plan A and situation C. This is how you should calculate. Now we'll just do the calculations. So now under situation A and plan A, what is DCL? Sorry, DCL they are asking. So DFL into DOL. So what is the degree of operating leverage under situation A? Under situation A, that is degree of operating leverage is 1.33 is to 1. So 1.33. Under situation and plan A, under situation A, plan A, what is financial leverage? 1.25. So situation A and plan A, 1.33 into 1. Within bracket 1.33 into 1.25. Within bracket 1.33 into 1.25. So 1.6625. That is degree of combined leverage. That's all. This is what you should do for all 9. So we'll do for next one. Under situation B, plan A, what is DOL and DFL? Situation B and plan A. Situation B and plan A, 1.43 is the DFL. And situation B, what is the DOL? 3 is to 1. So 3 into 1.43. So within bracket, what is the DOL? Sorry, DOL is 2. 2 into 1.43. So second situation, that is situation B, plan A, 2 into within bracket 2 into 1.43. 2 into 1.43, that is 2.86. 2.86. So next, under situation C, plan A. Situation C, plan A, what is DFL? 2.5 is to 1. And what is DOL? 4. So within bracket 4 into 2.5. So under situation C, plan A, within bracket 4 into 2.5. So DCL is 10. So do this for remaining 6 areas, that is 6 calculations. You will get what is DCL. That's all. With this we have calculated degree of operating leverage, degree of financial leverage, and degree of combined leverage for all 9 situations. Sorry, all 9 categories. That is 3 situations and 9 plans. Done. With this we have completed problem number 5. Problem number 5 is over. Moving on to problem number 6. Problem number 6 is very easy problem. What you have to do is you should use this leverage, that is ratios, in order to find what is the marginal income statement. It's simply like reverse working. That's all. Okay. Fine. First we'll read the question. Problem number 6. The selected financial data for XYZ companies for the year ended 31st, that is year ended March 2013 are as follows. There are 3 companies XYZ, their financial data they have provided. What they have provided in the table, particulars XYZ, below the particulars variable expenses as a percentage of sales. They have given a variable ratio. So with this we can find what is contribution ratio. Simply, variables ratio for x is 66.67. So 100 minus 66.67, we'll get what is contribution ratio. So 1 minus variable cost ratio is simply contribution ratio that we have studied. PV ratio is equal to 1 minus variable cost ratio. PV ratio is nothing but contribution ratio. Then with that we can find contribution ratio. Next they have given interest. Next, degree of operating leverage they have given. What is the operating leverage formula? Contribution divided by EBIT. Okay. And next is degree of financial leverage. What is degree of financial leverage? EBIT divided by EBT. And what is income tax rate? With that income tax rate, we can find what is tax, and we can find what is PAT. Simple. With this, we can find what is marginal income statement of 3 companies. Prepare income statement of for XYZ company. Now, move on to notes. Problem number 6. Problem number 6. Statement number 1, marginal income statement. Statement number 1, marginal income statement. Marginal income statement. Below that, 4 columnar table. Below that 4 columnar table, first column particulars, second column X, third column Y, and last column Z. Particulars X, Y, and Z. Now, just take down the format alone. Then we will calculate the values by using the working notes, because working notes are very important for this sum. Without working notes, if you even calculate using the calculator and write the marginal income statement very clearly and all the numbers are correct also, they won't give marks, because working notes form part of the answer. Working notes only carry answer marks in this question. Okay, below that particular small a sales value, small a sales value, below that small b variable cost, below small b variable cost, below the small c contribution, small c contribution, below the small d fixed cost. We are just writing the format of the marginal income statement. Small d fixed cost, below that small e EBIT, small e EBIT, below that small f interest, small f interest, and below that small g EBT, small g EBT, and EBT minus tax rate. So below the small h tax rate, at the rate of tax rate they have given 50%, tax at the rate of 50%, and below that small I PAT. So this is the marginal income statement format. So leave, below that take down working notes. Below that leave 2 lines gap, take down working notes. Working notes. So here see, they have given us degree of operating leverage and degree of financial leverage. Okay. The degree of financial leverage, they have, what is the formula for degree of financial leverage? EBIT divided by EBT. So simple, EBIT divided by EBT is 3:1. Then what is EBIT minus EBT? 3 minus 1. Simple, as simple as that. See, EBIT, degree of financial leverage, is nothing but 3:1, which means EBIT divided by EBT is 3:1. So 3 times of EBT is EBIT. Okay. So now working notes below that, point number 1. Point number 1. Let's assume EBIT be X. Let's assume EBIT be X. Just take down small x. Let's assume EBIT be small x. Below that DFL, we are calculating DFL. DFL, 4 columnar table, DFL, first column X, second column Y, and third column Z. First column X, second column Y, and third column Z. Below that X, what is the formula for DFL? DFL is equal to EBIT minus EBT. That's all. What is EBT? EBIT minus interest. So we are assuming EBIT as X here. So in respect of X, below that 3 is equal to, that is DFL for X is 3. So 3 is equal to what we assumed EBIT, X. X divided by what is EBT? X minus 200. That is EBIT minus interest is EBT. The formula for DFL is EBIT divided by EBT, man. And for EBT, how we are calculating is EBIT minus interest is the EBT. So here we know EBIT is X and interest is 200. So X minus 200 is the EBT. So 3 is equal to X divided by X minus 200. 3 is equal to X divided by X minus 200. If this goes to the left hand side, 3X minus 600 is equal to X. 3X minus 600 is equal to X. So 2x is below that 2x is equal to 600. 2x is equal to 600. So x is equal to 300. Very easily we found the x. That EBIT is 300. Using DFL formula, we found EBIT is 300. And if we reduce the interest 200, we'll get EBT 100. That is fine. Okay, coming to next Y. Next column Y. What is degree of financial leverage? 4. So 4 is equal to, same we are assuming EBIT as x. X divided by x minus 300 is the interest. X divided by x minus 300. If we take this to the left hand side, 4x minus 1200 is equal to x. Below that 4x minus 1200 is equal to x. So if we bring this x to the left hand side, it will become minus. So 4x minus x, that is 3x is equal to 1200. 3x is equal to 1200. So x is equal to, below that x is equal to 400. X is equal to 400. So moving on to last column Z. What is the financial leverage? 2. So 2 is equal to x divided by x minus 1000. 2 is equal to x divided by x minus 1000. What is this x divided by x minus 1000? EBIT divided by EBT. EBIT we assumed x, and EBT we are assuming as EBIT minus interest. Here we know EBIT is x. So x minus interest is 1000. X divided by x minus 1000. So below the 2x minus 2000 is equal to x. So x is equal to 2000. So x is equal to 2000. With this we have found what is EBIT. So now copy the EBIT. EBIT we assumed as x. All the three values x are EBIT. So take today point number, small number EBIT, that is for x 300, for y 400, and for z it is 2000. In respect of EBIT, for x 300, y 400, and z is 2000. In respect of interest, take down. What is the interest they have given in the question? 200, 200, 300, and 1000. 200, 300, and 1000. Now EBIT minus interest is EBIT. EBIT minus interest is EBT, that is earnings before tax. Now deduct it. 300 minus 200. In respect of EBT column, record 1000. In respect of EBT column, record 1000. And next is 400 minus 300. In respect of EBT column, record 1000. 100. Sorry, both are 100. Sorry. In respect of x, 300 minus 200, EBT is 100. EBT is 100. And in respect of y column, 400 minus 300, EBT is 100. And in respect of z column, 2000 minus 1000, that is 1000. EBT is 1000. EBT is 1000. Now we have calculated what is EBT, and they have given us the income tax rate. With that we can easily find what is tax at the rate of 50%, and then we can find profit after tax. So in respect of the tax at the rate of 50%, calculate it. 100 into 50%, that is 50. 50 within bracket 50. Next 100. Next for y column, 100 into 50%. Tax rate at 50% is 50. In respect of h, 50. And the last column, 1000 into 50%. In respect of tax rate, 500. That is 500. Now underline it. Total it. In respect of profit after tax, for x column, 100 minus 50, you are getting 50. Profit after tax is 50. And in respect of y column, 100 minus 50, profit after tax is 50. And z column, 1000 minus 500, profit after tax is 500. So we have calculated the lower part of the income statement using DFL. Now using DOL, we can easily find the upper part. So now moving on to the working notes. Below that, small Roman number 2, operating leverage. Operating leverage. Let's assume operating leverage, underline it. Below that, right, let's assume contribution be y. Let contribution be y within bracket, within apostrophe, that is y. So below that, 4 columnar table, that is particulars x, y, and z. Particulars x, y, and z. X, y, and z. Below that, particulars DOL. What is the formula for DOL? Degree of operating leverage, contribution divided by EBIT. Here we know what is EBIT because we found it in the previous working note. So we know what is EBIT and we know what is DOL, that is degree of operating leverage. They have given the question. With that, we can easily find what is contribution. No, that is Y. So take down in respect of X column, DOL in respect of X column. What is the DOL? They have given 5 is to 1. So 5 is equal to contribution divided by EBIT. That is contribution we assumed as X, Y. Sorry, contribution we assumed as Y. So 5 is equal to Y divided by what is EBIT for X? That is 300. So Y divided by 300. Y is equal to Y divided by 300. Below that, Y is equal to 300 to 500. That is 1500. Y is equal to 1500. 1500. Okay. Next, for Y, for company Y, 6 is equal to DOL is 6 is to 1. So 6 is equal to contribution is Y. So Y divided by EBIT is 400. So 6 is equal to Y divided by 400. So Y is equal to 2400. Y is equal to 2400. And next is Z. In respect of Z company, what is DOL? 2. 2 is to 1. So 2 is equal to Y divided by what is EBIT? 2000. 2 is equal to Y divided by 2000. Below that, Y is equal to 4000. Y is equal to 4000. Now we found what is contribution. 1500, 2400 and 4000. So copy it. In respect of contribution, take down 1500 in respect of X column, 1500 in respect of X column, and 2400 in respect of Y column, and 4000 in respect of Z column. 1500, 2400 and 4000. See, contribution minus fixed cost is EBIT. So we can find what is fixed cost very easily. So contribution minus EBIT will get fixed cost. So what is contribution? 1500. What is EBIT? 300. So 1500 minus 300, you will get 1200. So fixed cost in respect of X column 1200. Fixed cost in respect of X column 1200 within bracket, because fixed cost we should always deduct within bracket. So next, in respect of Y column, contribution is 2400 and EBIT is 400. So 2400 minus 400, you will get 2000. So contribution in respect of Y column is fixed cost in respect of Y column is 2000 within bracket. 2000 within bracket. And for the last column, contribution is 4000 and EBIT is 2000. So contribution 4000 minus EBIT 2000. You will get 2000 is fixed cost. So within bracket Z column, fixed cost is 2000. Within bracket 2000. Now just see, contribution is 1500. Within bracket 1200. So 1500 minus 1200, you are getting 300. Minus interest 200, you are getting 100. Minus tax at the rate of 50% is 50. So you are getting profit after tax 50. So entire calculation is correct. We have found till contribution. So using this contribution and using this variable expenses as a percentage of sales, that is variable cost ratio, we can easily find what is sales value and variable cost. Now for that, working note number 3. Row number 3, calculation of sales value. Below that, operating leverage, take down. Small row number 3, calculation of sales value. Below that, 4 columnar table. First column particulars, second column X, third column Y, and fourth column Z. Particulars X, Y, and Z. Below that particulars, small a, contribution. Below that particular small a, contribution. What is the contribution which we found? Y, see, for company X 1500, company Y 2400, company Z 4000. Copy it. Contribution in respect of X column 1500, in respect of Y column 2400, and in respect of Z column 4000. That is the total contribution. So contribution divided by contribution percentage will get sales value. That is the formula actually. Contribution divided by contribution percentage, that is contribution ratio, you will get sales value. So here we don't know what is contribution ratio, but we know what is variable cost ratio. So 1 minus variable cost ratio is nothing but contribution ratio. So below that, small b, contribution ratio. Contribution ratio. Within bracket 1 minus variable cost ratio. Within bracket 1 minus variable cost ratio. So here for company X, what is the variable cost ratio? 66.67. So what is the contribution ratio? So 1 minus 0.6667, you will get 0.33. So that is 1 by 3. Simple man. X, they have given variable expenses as a percentage of sales is 2 by 3. Then what is contribution ratio? 1 by 3. So in respect of x, put 1 by 3. 3 minus 2 by 3 is equal to 1 by 3. 1 by 3. And for next, variable cost ratio for y is 75%. Then what is contribution ratio? 25%. 1 minus 75% is 25. 100 minus 75 is 25. So in respect of y, 100 minus 25% within bracket, below that 25%. In respect of y, contribution ratio is 25%. And z is variable expense ratio is 50%. So 1 minus 50%, that is within bracket 100 minus 50%. In respect of z column, 100 minus 50%, below that is equal to 50%. So contribution ratio is 1 by 3, 25% and 50%. So if we divide both A divided by B, you will get sales value. So below that, small c, sales value, small c, sales value, within bracket A by B, within bracket A by B. Okay, in respect of x, 1500 divided by 1 into 3, because it is 1 by 3, we are reciprocating it. Reciprocal will be 3 by 1. So 1500 into 3 by 1, that is 4500. In respect of x, 4500, or we can even do this 1500 divided by 33.33%. We are getting 4500 because variable cost ratio is 66.67%. What is contribution ratio? 33.33%. So 1500 divided by 33.33%, we'll get 4500. And for y, company Y, third column, 2400 divided by 25%. 2400 divided by 25%. In respect of sales value, put 9600. Put 9600. And last column Z, that is 4000 divided by 50%. 4000 divided by 50%. In respect of sales value, put 8000. 4000 divided by 50%, that is 8000. So contribution is equal to sales into contribution ratio. Now again, for cross checking, just multiply it. You know what is contribution ratio, you know what is sales value, and for contribution is equal to sales into contribution ratio. Here sales is 8000, okay, contribution ratio is 50%. So 8000 into 50%, that is contribution should be 4000. So contribution is 4000. And for this, sales value is 9600, contribution ratio is 25%. So 9600 into 25%, you should get contribution is 2400. So here contribution is 2400. Simple. Contribution divided by contribution ratio, you'll get sales value, because sales value is equal to, sorry, contribution is equal to sales into contribution ratio. Reverse working. That's all. We have found what is sales value for all three companies. Now copy it. 4500, 9600 and 8000. In respect of sales value, for company X 4500, for company Y 9600, and company Z 8000 rupees. 4500, 9600 and 8000 rupees. Now, what is variable cost? It is a balancing figure. That is sales value minus contribution, you will get variable cost, because sales value minus variable cost is equal to contribution. If variable cost goes to that side, it will become positive, and contribution come to the left hand side, it will become negative. So sales minus contribution, you will get variable cost. What is sales? 4500 minus what is contribution? 1500. So variable cost is 3000. So within bracket 3000. Within bracket 3000. You should do same thing for all three. So 9600 minus 2500. 9600 minus 2400. You will get within bracket 7200 variable cost. 7200 within bracket. And for last column Z, 8000 minus 4000. So variable cost within bracket 4000. Within bracket 4000. Now just calculate. We'll cross verify it. For company X, sales value is 4500. From that, if you reduce variable cost 3000, that is how much is the variable cost as percentage of sales? 66.67. So 4500 into 66.67%, that is 3000. So variable cost is 3000 within bracket 3000. So 4500 minus 3000, you will get contribution 1500. From the contribution 1500, if you deduct fixed cost 1200, which we found 1200, we will get EBIT 300. From that EBIT 300, if we deduct interest, that is 200, we will get EBT 100. And from EBT 100, if we deduct tax at the rate of 50%, that is 50, we will get profit after tax 50. That's all. Very easy concept. But the thing is, it will take time to do the problem. Okay, with this problem number 6 is over. So one more thing I should tell you. problem number 6 and problem number 9 are same. Okay, so problem number 9 is your homework. You just do it on your own. Same thing. Take down the formulas. What is financial leverage? EBIT divided by EBT. Use that. Put EBIT as X. Then calculate the financial leverage. Then calculate the what is EBIT. From the EBIT, deduct the interest amount. You'll get EBT. From that, deduct the income tax rate 45%. You'll get PAT. So same format. So problem number 9 also done. Mark it as done. Homework. And next is problem number 8. Problem number 8. Take down. First read the question. Problem number 8. Find out the operating leverage from the following data. Find out the operating leverage from the following data. What they have given sales. They are asking us to calculate operating leverage from the data, and they have given one more question, that is find the financial leverage. There are two to separate A and B. This is actually examination question. Yeah, December 2013 question. See, one more thing. Don't think like if they have mentioned December 2013, it is December 2013. They didn't ask after that. Once it is coming under examination question, they will keep repeating the question. December 2013, June 2014, then December 2017. Again and again, they will be asking the examination. So if they mention December 2013, it will be asked again in the exams. So once it is mentioned as examination question, there is a probability that they will ask the same sum in the examination. Okay, problem number 8. Find out the operating leverage from the following data. They are given sales, variable cost, and fixed cost. From that, we should find operating leverage. What is the formula for operating leverage? Contribution divided by EBIT. From this, we can easily find contribution, and we can find what is EBIT. So, put that in. Problem number 8. Coming to the notes. Problem number 8. Statement number 1. Statement number 1. Calculation of degree of operating leverage. DOL. Calculation of DOL. Below that, 2 columnar table. First column particulars, second column amount. First column particulars, second column amount. Below that particulars, small row number 1, sales. Sales. In respect of amount column, what is the sales? They have given 50,000. In respect of amount column, 50,000. Below that, less variable cost. What is the variable cost percentage? They have given 60%. So variable cost at the rate of 60%. So what is the variable cost? 50,000 into 60%. That is within bracket 30,000. Within bracket 30,000. Calculate 50,000 into 30%. 60%. What is that? 30,000. So in respect of variable cost, in amount column within bracket 30,000. Now total it. Underline it. 50,000 minus 30,000, you will get 20,000. 20,000. In respect of the 20,000, record contribution. Record contribution. From that contribution, reduce fixed cost. How much they have given? 12,000. So fixed cost reduce it 12,000. Within bracket 12,000. 20,000 minus 12,000. Total it. Amount column put 8,000. Amount column put 8,000. In respect of that 8,000, record EBIT. EBIT. So what is that EBIT? 8,000. On what is contribution? 20,000. So if we divide this both, you will get operating leverage. Below that, leave one line gap. Operating leverage is equal to contribution divided by EBIT. Operating leverage formula is contribution divided by EBIT. Financial leverage formula is EBIT divided by EBT. Combined leverage formula is contribution divided by EBT. 3 formulas. Write it down in a paper. Revise it whenever you have time. So contribution divided by EBT. What is contribution given here? Is equal to 20,000 divided by 8,000. 20,000 divided by 8,000. So 20,000 divided by 8,000 is equal to 2.5:1. Is equal to 2.5:1. So okay, done. That is point number 1. And coming to next point number 2. Find out the financial leverage from the following data. Find out the financial leverage from the following data. Net worth, they have given 25 lakhs. Debt to equity 3:1. Interest rate they have given 12%. And operating profit they have given 20 lakhs. With this, we should find financial leverage. So financial leverage is nothing but EBIT minus EBT. EBIT minus interest rate, you will get EBT. So EBIT divided by EBT is financial leverage. First, we should calculate what is EBIT. See, operating profit they have given. That operating profit is nothing but earning before interest and tax. 1 minus interest 12%. That is 12% on the debt fund. That is debt to equity is 3:1. So 25 lakhs is net worth. 25 lakhs divided by 4 into 3. That is the debt. So we should calculate a debt and into interest rate of 12%. That will be the interest. If you deduct EBIT minus interest, you will get EBT. So EBIT divided by EBT will be degree of financial leverage. Okay, put that in. Statement number 2. Below that, statement number 2, calculation of financial leverage. Calculation of financial leverage. Below that, 2 column table. First column particular, second column amount. First column particular, second column amount. Below that particulars, EBIT. EBIT. Amount column put 20 lakhs. Operating profit is nothing but EBIT. So amount column put 20 lakhs. Less interest. Below that, less interest. We should calculate what is interest. They have given interest is 12%. Net worth they have given 25 lakhs and debt to equity ratio 3:1. So below that, leave 2 lines gap, leave 4 lines gap. How much is the total debt amount we should calculate? Debt is equal to 25 lakhs. See, 25 lakhs net worth man. Debt to equity is 3:1. So total net worth is nothing but 3 plus 1 is total net worth. Debt plus equity is equal to net worth. So 3 plus 1 is equal to 4. So 4 is equal to 25 lakhs. So then how much is 3? That is debt. So okay, debt is equal to 25 lakhs into 3 by 4. 25 lakhs into 3 by 4. What they have done here? 25 lakhs. Net worth is okay. Sorry. Net worth is nothing but equity. Okay, here we are assuming net worth as equity. Okay, so equity they have given 25 lakhs. Then what is debt we should calculate? Here one is 25 lakhs and next what? I just assume net worth as capital employed. Sorry, net worth is different from capital employed. Capital employed is summation of debt plus equity, whereas net worth is only equity. So net worth is only equity. That is 1 is 25,000. Then what is 3? So debt is equal to 25 lakhs into 3. 25 lakhs into 3 is equal to 75 lakhs. So total debt is 75 lakhs. Below that, interest is equal to, at what rate they are giving? 12%. So interest rate is equal to 75 lakhs into 12%. 75 lakhs into 12% is equal to 9 lakhs. Now we have found what is interest. Now moving on to the table, in respect of interest column, within bracket 9 lakhs. Within bracket 9 lakhs. Now total it. Amount column 20 lakhs minus 9 lakhs is 11 lakhs. 11 lakhs. In respect of the 11 lakhs, EBT. So EBT is 11 lakhs. EBIT is 20 lakhs. So below that interest, DFL is equal to degree of financial leverage. DFL is equal to EBIT divided by EBT. EBIT divided by EBT. That is equal to 20 lakhs divided by 11 lakhs is equal to 1.82:1 is equal to 1.82:1. 1.82:1. So one more last sum is left over is problem number 10. Actually, in this problem number 10, it is repeated one. So sir has removed this problem. He has changed the other problem for problem number 10. This problem number 10 is repeating from the, I think so, problem number 6 or 7 something. So don't worry about this problem number 10. So the material, in your material, the problem number 10 is ABC Limited. See, actually for this problem number 10, the answer will be available in Institute material. So Institute material, page number 454, illustration 52. Both are same. Problem number 10 and illustration 52 are same. I'll just explain you the problem. You just take the notes from this problem. Okay. See, illustration ABC Limited or both are same. ABC Limited wants to raise 5 lakh rupees as additional capital. It has two mutually exclusive alternative financial plans. So it has two plans for raising 5 lakhs as additional capital. So the current EBIT is 17 lakhs, which is likely to remain unchanged. The relevant information in the present capital structure is the present capital structure is 3 lakh equity shares of 10 each. That is 30 lakhs of equity and 20 lakhs of bonds, total 50 lakhs. And it wants to raise extra 5 lakh. And the current EBIT is 17 lakhs. That is what explained in the paragraph. And in the tabular column, tax rate is 50%. Current EBIT is again they are told 17 lakhs. Current EPS is 2.5. So 17 lakhs divided by what is the total number of equity shares? 3 lakhs. So 17 lakhs divided by 3 lakh equity shares, 3.66. Whereas current EPS is 2.5. Current EPS is 2.5. They are distributing only 2.5 rupees of earnings per share. So okay, earnings per share is 2.5. And current market price is 25 per share. The share price at which the market market price at which the share is traded is rupees 25 rupees per share. And there are two plans for raising this 5 lakh additional capital. Financial plan 1, issuing 20,000 equity shares of at 25 per share, or financial plan 2, 12% debentures of 5 lakh. So these are the two financial plans. They are asking us what is the indifference level of EBIT and identify the financial break-even levels. At which level both financial plans are acceptable, and what is the indifference level of EBIT they are asking you. So now we should calculate what is the indifference level. Moving on to the solution, just take the institute material, take page number 485, I guess. One second. 454, page number 454, illustration number 52. 454, illustration number 52. Same question. Now come to the solution. First, what they are computing is computation of EBIT EPS indifference point. That is, see, there are two financial plans. Okay, plan number 1 is raising entire capital as equity, issuing new 20,000 shares at the rate of 25 per share. Second is procuring all 5 lakh funds from debt at the rate of 12% debentures. At the rate of 12%. Okay, so now solution. What they have given is statement number 1, computation of EBIT EPS indifference levels. EBIT and EPS indifference level they are calculating. So particulars financial plan, you just take down it afterwards. I'll just explain you this one. Particulars financial plan, that is 1 equity, and financial plan 2 is debt. In case of if you are going with financial plan 1 equity, owner's funds will increase by from 30 lakhs to 35 lakhs. Correct? No, right? Presently owner's funds is 3 lakh into 10 rupees each, that is 30 lakhs, plus one more additional 5 lakhs will be increased, that is 35 lakhs will be your total capital employed. So owner's funds will be 35 lakhs and borrowed funds will be same, that is 20 lakhs. So total capital employed will be 55 lakhs in case of financial plan 1, that is equity. And in case of financial plan 2, owner's funds will remain the same, that is 3 lakh into 10, that is 30 lakhs, and borrowed funds given is increase from 20 lakhs is the current debt, whereas you are procuring another 5 lakhs as debentures, 12% debentures. So it will increase to 25 lakhs. Now total capital employed is 55 lakhs in financial plan 2 also. That is table number 1. And next table what they have explained is what is the EPS they are calculating, indifference EPS. So what they are doing is first they are assuming EBIT as X and X. Currently the EBIT is 17 lakhs, but we know the future EBIT after going with the financial plan 1 and financial plan 2. So first they are assuming EBIT as X, then less from that interest. In case of financial plan 1, interest rate is 20 lakhs into 10%, because already we have procured interest at the rate of 10%, 20 lakh rupees. So 20 lakh rupees debentures at the rate of 10% is the interest. So 2 lakh rupees. So interest is 2 lakh rupees. So EBT is X minus 2 lakh rupees. Whereas financial plan 2, you are procuring another 5 lakhs at 12%. So 5 lakhs into 12%, that is 60,000 plus 2 lakhs, old one. So 2 lakh 60,000. So EBT will be X minus 2 lakh 60,000. Till this you are clear. Here, why the interest rate is changing is, if you are going with financial plan 1, there will be same funds. So it is 2 lakh. Whereas if you are going with financial plan 2, increase in debt, that is 60,000 interest. So 2 lakh 60,000. Below that, less tax at the rate of 50%. In question itself, they have given 50%. So x will become 0.5x and 2 lakh will become 1 lakh. So tax at the rate of 50%, EAT, that is earnings after tax. Profit after tax is 0.5x minus 1 lakh, whereas in financial plan 2, 0.5x minus 1 lakh 30,000. That is the profit after tax. Then below that, number of equity shares issued. In case of financial plan 1, you are issuing extra 20,000 shares, sir. So 3 lakh existing shares plus 20,000 shares, that is 3 lakh 20,000 shares. Whereas in case of financial plan 2, debt is increasing, whereas financial, that is equity, is remaining same, that is 3 lakh shares. So here number of equity shares in financial plan 2 is 3 lakh shares. If you divide both, that is EAT, that is earnings after tax divided by number of equity shares, you will get EPS. So 0.5x minus 1 lakh divided by 3 lakh 20,000 and 0.5x minus 1 lakh 30 divided by 3 lakh, which will be earnings per share. And for calculating the indifference point, that is indifference EBIT, the thing which we should do is we should equate this financial plan 1 and financial plan 2. That's all. From that we'll get what is the EBIT at which both the financial plans will be giving same EBIT. So for indifference between the above alternatives, financial plan 1 and 2, EPS should be equal. If this both the plans should be indifferent, then EPS should be equal. Hence 0.5x minus 1 lakh divided by 3 lakh is equal to 0.5x. So they have changed the number here. Yeah, 0.5x into minus 1 lakh divided by 3 lakh 20 is equal to 0.5x minus 1 lakh 30 divided by 3 lakh. So if we multiply both, if this 3 lakh 20, actually we printed wrongly, this is 3 lakh 20 and this is 3 lakh. So if we cross multiply, on cross multiplication, 1.5x minus 30 lakhs is equal to, see here 3 lakh should come, here 3 lakh 20 should come. If this 3 lakh is multiplied with this numerator, 3 lakh into 0.5, that is 1.5x. 1.5x minus 1 lakh into 30 lakhs. So 1.5x minus 30 lakhs is equal to 3 lakh 20 into 0.2, that is 16 into 16x minus 14.16 lakhs, or x is equal to 11.6. If you cross multiply this, you will get x is equal to 11.6 lakhs. Okay, the x, that is EBIT, is equal to 11.6 lakhs. So at 11.6 lakhs, 11 lakh 60,000, and at that level EPS will be 1.5 under both the alternatives. That's all. Simple. Under 11.6 lakhs, there will be indifferent point of EPS. That is, EPS will be 1.5 under both the alternatives. That's all. So below that, computation of financial break-even point. That is, financial break-even point is nothing but for two plans, what is the break-even point financially? For plan 1, EBIT is equal to 2 lakhs. That is 10% interest on 20 lakhs. And plan 2, EBIT is equal to 2 lakh 60. That's all. Actually, this sum is from final. Okay. But the thing is, they have asked this sum actually in inter once. The financial break-even point for the two plans, that is, financial break-even point is nothing but what is the interest amount you are paying. That is the financial break-even point. Here, the financial break-even point is nothing but for plan A, EBIT is equal to 2 lakhs, because if you are getting 2 lakhs as EBIT, you can pay your interest amount. So that is the financial BEP. Whereas for plan B, interest itself is 2 lakh 60. So you should have EBIT 2 lakh 60 in order to financially break even. So that is called financial break even point. So just simply take down this problem in your notes. That is problem number 10. So with this, we have completed our leverage analysis. So done with our leverage analysis. In the next video, we'll start off the next chapter. So leverage analysis is also an important chapter. Just work it out as and when you are getting your videos. Okay guys, prepare well. All the best. Thank you.